Good day, this is Shauna Casey, and welcome to this SOS educational webcast, Market Trends in ESPP Design. Due to the large number of attendees, no conference call service is available for this webcast. The sound will broadcast through your computer speakers. However, if you wish to ask a question at any time during the presentation, please feel free to type it into the questions and answers panel of your GoToWebcast console, and we will do our best to answer them as they come in. Any questions that we don't get a chance to address during the webcast, we will follow up with afterwards in an email. This morning we sent an email with a link to the presentation materials to everyone that registered as of 10 a.m. Pacific this morning. You can also find the link to the materials under the Event Resources tab on your GoToWebcast console. This session will also be recorded, and we will send a link to the recording of materials in the next day or two. I hope that all of you are familiar with Stock and Option Solutions, or SOS as we are more commonly known. For those of you who are not, SOS is a leading stock administration, staffing, consulting, and outsourcing firm within the equity compensation marketplace. SOS provides interim and permanent placement, expert project resources, and total outsourcing solutions. To learn more, you can visit us online at www.sos-team.com or call us at 408-979-8700. Next, I'd like to introduce you to our speakers for today's session. We are pleased to have Emily Cervino, Julie Kenia, and Liz Stoudt on the panel today. Emily has worked in varied roles in the equity compensation industry since 1998, and she has a unique appreciation for the opportunities and challenges of equity compensation. At Fidelity Stock Plan Services, Emily focuses on strategic marketing initiatives, thought leadership, and building Fidelity's strong industry presence. In her former role as Executive Director of the Certified Equity Professional Institute at SCU, Emily was involved in all aspects of certification, research, and program marketing. In previous roles, Emily managed all the equity compensation programs at National Semiconductor and held various roles at E-Trade Share Data. Emily is a frequent speaker at equity compensation events, past president of the Silicon Valley chapter of the NASPP, a member of NASPP, GEO, and NCEO, and a 2015 recipient of the NASPP's Individual Achievement Award. Emily is a certified equity professional, and she holds Series 7 and 63 securities registrations. Julie has been a member of the SOS team since 2006 and is currently a member of the Professional Services team, where her extensive background and experience help clients with their employee equity plan challenges. Julie has assisted clients with corporate spin-offs, mergers, stock splits, stock plan best practice reviews, software training, day-to-day administration training, vendor evaluations and implementations, and accounting-related reconciliations. She has also assisted with ESPP expensing, data audits and conversions, and 6039 compliance. Julie became a certified equity professional in 2008 and has over 20 years of experience in long-term incentive programs and equity administration. She has presented on SOS webinars at the annual NASPP conferences and at local NASPP chapter meetings. Liz is a director at Aon with more than 14 years of benefits and compensation consulting experience. Liz collaborates directly with management and the compensation committees of companies to design sound equity compensation programs, practices, and procedures. She also works with companies on the valuation and financial management of their compensation programs. Liz is a frequent speaker at various conferences and seminars, including national and local NASPP meetings, the CEP Symposium, and GEO's International and NECF conferences. Liz has attained the Associate of the Society of Actuaries and the Certified Equity Professional designations. Liz currently serves on the CEP Certification Council, has volunteered on numerous test development activities for the CEPI, and has been recognized with numerous Volunteer Excellence Awards. Next is our standard disclaimer slide. We'd like to remind you to consult your own advisors before making any changes. As I mentioned, the materials are available on our website, and here again is the link. Thank you all for joining us today. And with that, I'll turn this presentation over to Julie, who will introduce our topic and cover the agenda. Thank you.
Thanks, Shauna. Well, today I am fortunate to be with Emily and Liz as they present to us their survey results for their ESPP design and market trends. We will first go over the introduction of the survey parameters, and then we will discuss plan design, plan participation, and then following that we will finish up with some ESPP trends that have been seen over the last 2 years. So with that, I am going to hand over the presentation to Emily, who is going to bring us into the plan design and introduce the scope of the survey for us. So Emily?
Great. Thanks, Julie, and thanks for having me. ESPP is definitely one of my favorite topics, so I always look forward to an opportunity to share information on ESPP. So I want to give you a little bit of background on the research that we're going to be sharing with you today. We have definitely seen an uptick in interest in employee stock purchase plans over the last 18 to 24 months. I think there's a lot of things that are driving this uptick in interest, particularly a tighter labor market where companies are looking to put in more attractive benefits and differentiated benefit programs for an employee satisfaction perspective. As a result of this increase of interest in ESPP, we were receiving a lot of questions from our clients about ESPP and what the most common ESPP design features are, as well as how different design features are impacting participation. And given that we sit on a tremendous amount of data at Fidelity from managing all of our clients' plans, we thought that we could really put together a pretty compelling analysis of this data that would give information around ESPP that we aren't able to see elsewhere. Most of the ESPP information that we see is survey-based information, and as a separate approach to this, rather than doing a survey, we're actually doing a data analysis by looking at the information stored on our record-keeping platforms and analyzing specifically how that data and the plan design elements are, the prevalence of them, as well as how they impact participation. And I partnered with Liz at Radford Aon. The first time we did this was in 2014, and then we partnered again on this analysis based on data on our platform as of June 30th, 2016. So the analysis that we're going to cover with you today includes 175 ESPPs with nearly 4 million eligible participants. And we'll take you through the plan design elements and prevalence of plan design elements, as well as how those plan design elements impact participation. I think this is particularly helpful for companies who are looking at modifying ESPPs or looking at putting in new ESPPs so that you can maximize your participation by picking the right plan design features. With that, Liz, I'll turn it over to you on the next slide to take a look at plan design basics.
Sure. So these are what I would call the fundamental design decisions. Whether or not you have a qualified or a non-qualified plan, what is the length of the offering and purchase period going to be, what level of discount are you going to offer, and the price type, either based on the ending price or a look back, which is the lesser of the beginning or the ending price. So these are the fundamental decisions that are going to drive participation in the plan. It's going to drive the compensation expense for the plan, and it's also going to drive the share usage for the plan. So just, going through these kind of quickly, most plans, about 80%, are tax qualified for 23 plans. Most plans have a 15% discount. Most plans also have either a 6-month followed by a 3-month purchase period. And the other thing to note is that, across all plans, the ending price is more common, but for non-safe harbor plans, we see that a look back is more prevalent. Safe harbor meaning that you have at most a 5% discount and no look back, and you don't have a compensation expense associated with that type of plan design. Now you're going to see as we continue through the deck, there are obviously numerous combinations of these different features. And some designs are more prevalent than others, but there's definitely variation, certainly on a company basis, but we do see sort of some general trends by industry as well.
Liz, can I ask you a question on the length of the purchase period, the prevalent one being 6 months there? Is this, and I think Emily had mentioned it to me, that this survey really looked at that 6-month purchase is really the same as a 6-month offering. There wasn't really a look here at, say, a 24-month offering with 6-month purchases. So when we see 6 months here, we're really looking at a 6-month offering and a 6-month purchase, right?
That's correct. This data set, there were very few of what I would call the Cadillac plan design, like where you have a 24-month offering with 4 6-month purchase periods. Sometimes you might have a 12-month offering with 2 6-month purchase periods. There were only a couple of these in the data, and so, because it wasn't statistically significant, we carved those out.
Yeah, and Liz, I'll pipe in on that as well. And those certainly are Cadillac plans outside of Silicon Valley and outside of technology and life sciences. Those plans are virtually unheard of. So when you look across the ESPP landscape, those represent a very, very small number of ESPPs that are out there, and an even smaller number of new ESPPs that are being put in place. Increasingly, we're seeing that those truly are legacy plans. There may be, sometimes we see a little bit of appetite for that in the IPO market, but outside of that, it's very, very uncommon to see a new ESPP go in with a 24-month offering. So for the purposes of this analysis, we focused on the length of the purchase period rather than the length of the offering period.
Great.
All right, so with that, I will pick up the next slide here, and while Liz got to cover the fundamental design decisions for ESPP, I guess I get to cover the not so fundamental design decisions. So while, certainly the tax status of the plan, the length of the purchase period, the discount, and the price type are really critical components that shape your plan, there are a lot of other decisions that have to be made with an ESPP. Now, I would consider these to be more on the non-fundamental side, because I think about this with respect to, are these the kinds of decisions that drive an employee to decide to participate or not to participate in the plan? So while these decisions need to be made, they may not have as big of an impact on participation in your plan. And the first one is contribution type, whether or not you allow contributions as a percentage of salary, as a flat dollar amount, or as both. I think it's highly unlikely that a participant would say, oh, I'm not going to participate in that plan because I can only do a percentage and I want to do a dollar amount. I think that that's a rather unlikely scenario, but as you can see, the vast majority of companies are using a percentage contribution type, with a few using dollars, and even a fewer number are allowing employees to choose either a percentage or a dollar amount. Now, with respect to withdrawals allowed, I think this potentially could have a little bit more impact on participation, but I do think that the concept of allowing withdrawals is associated with the length of the purchase period. So 67% of the clients in our data set do allow withdrawals, 33% don't allow withdrawals, but we do have some short purchase periods. So where a purchase period is, say, a 1-month period, it's not necessary that plan sponsors contemplate allowing for withdrawals, because I think that's a really short period of time that employees ought to be able to commit to a 1-month period. Where withdrawals may have an impact on participation is really on those longer purchase periods where employees are concerned that if they have a need for the money, they want to be able to have access to that. Another kind of surprising finding here was the maximum shares per purchase, where the majority of clients on our data set do not have a maximum shares per purchase. And of course, with the final regs, 2009, the 423 final regs, in order to consider the offering begin date as the grant date, companies do need to establish a fixed and determinable limit. So I'm a little surprised to see that so many of the clients in the data set don't have a limit associated with their plans. Now, some of those truly are plans. Oh, I'm sorry. Go ahead,
Emily,
Julie.
we tend to see companies that don't actually specify that, and we do go back to them on it and question why they don't have a limit specified. And some of them have said that their attorneys have ruled that the 25K rule language gives them their limit, that they probably would never hit a limit because of that. And it's odd to us because you're right, they don't establish the grant date.
Yeah, and we do also see in some cases that the limit is so high that clients don't feel the need to pass the limit because it's set in a way that employees are never going to hit it. You know, there needs to be a limit in order to establish the grant date, but it doesn't have to be a reasonable limit. So you could put a limit of 1 million shares per employee. Now, no employee is ever going to hit that, so, you know, as a result, is it necessary to track against it? So that could be an explanation. But I am a little surprised, Julie, because I would expect more plans to have a specified share limit. I think it's also a great way to manage the share usage so that you can forecast the life of your plan much better.
Exactly. I don't think that that's thought through on some plan designs.
And the last piece here is the non-qualified plans. Non-qualified plans do represent the minority of plans that we support, but I think non-qualified plans are actually a really exciting opportunity for some companies because it allows you to design the plan outside of the restrictions of 423. And you can see that the majority of the plans here, I think are actually, I'm just noticing this here, our legend is a little bit off. So we've got 32% of companies that don't offer a match or a discount. We have 20, I think that's, oh, look at that now. I think it's, Liz, do you remember 23 is the match and 45 is the discount? I believe that's the correct answers. We can get that corrected for you. I apologize for that.
It's the opposite, Emily. I think the match is more prevalent than the discount.
Okay, the match is more prevalent than the discount. And that, I think, is why companies like a non-qualified plan, that it offers them the ability to do a little bit more interesting things and offer a match, either a dollar match or a share match on their plans. And we're going to look at participation later on, and you'll see that some of these non-qualified plans have some pretty impressive participation rates because those matches and discounts can be much more compelling than the 15% that's offered under a Section 423 plan.
All right, and so continuing with, I guess I would call them, non-fundamental plan design decisions. These are, again, most of these decisions shouldn't impact whether or not an employee would choose to participate in the plan, but these are things I think to consider for administrative reasons or even accounting reasons. So going through these, starting with a minimum contribution percentage, most companies do establish a minimum percentage. I think 1% is the most common. In terms of a maximum contribution percentage, a 10 or a 15% max contribution is the most common that we've seen. Now, a maximum contribution percentage is going to naturally limit the amount of contributions that employees can make, and thus that will help control the share usage and also the compensation expense. Now, we do see 25% of companies have no limit at all, and 8% have pretty high limits. So companies that have no max or a high maximum amount basically are just wanting to allow all employees to be able to contribute the maximum amount they're able to, up to any IRS or other share limits. So, a person making $50,000 could contribute as much as somebody making $200,000 if they so desired. But overall, the predominant choices tend to be 10 or 15%. The one thing that I have seen sort of coupled with this is that the choice between 10 or 15% is sometimes coupled with the decision around how to define eligible comp. So a company that's defining eligible compensation just based on base pay, I think is more likely to go with a 15% maximum allowable contribution, whereas a company who's going to also include things like bonuses or commissions and overtime might choose a 10% maximum contribution rate. So in terms of allowing increases or decreases during the purchase period, not allowing either one of these things to occur is the most common, and that's going to be the simplest from an administrative perspective. If you want to offer some flexibility to employees, I think it makes your life a lot easier if you can limit those changes, and I would recommend limiting to one decrease in a purchase period and not allowing increases. I think increases in contribution are kind of like a whole other animal because increases in contributions will trigger modification accounting. That's something that you really want to try to avoid if at all possible. Obviously it increases your expense, but it can be a little bit of a nightmare to track sometimes. Now,
we have terrible time with that with clients that continuously have increases because they have a 2-year plan with 4 purchase periods, and they allow multiple increases in each purchase period. So, it just goes on and on and on. And every time that person does an increase, we have to track it to create a modification to their accounting. And it's really hard for the clients to understand that, and they think that we're trying to pull the wool over their eyes or something. But the fact of the matter is, when you do an increase, you've got a new grant date for that person. So we have to value it and come up with a new expense, and that can get pretty costly over time.
Yeah, and that also goes to the length of the offering period, right? If you've got a 2-year offering period, I can understand why you would want to allow employees some flexibility. That also further encourages participation in the plan, knowing that at the beginning of a 2-year period, they don't have to pick a contribution level and be tied to it for 2 years. I think in the case of Cadillac plans like that, the one thing that can help a little bit is, not allowing employees to make an increase that takes effect in the middle of the purchase period, because then employees could do that every single day during the purchase period if they so desired, but just allowing an increase once per purchase period and having it take effect at the beginning of each new purchase period, so then everybody's modified on the same date.
Right. That's what we encourage when we see that. The other thing that does too is we try to make sure that everyone understands within their enrollment material that when they're allowing the increases, that what's the timing of accepting those increases and the decreases even. What's the timeline? Can you do it the day before the purchase, or can you do it 6 weeks before the purchase? What's the limit? Usually we try to recommend something like 10 days or some period that will correspond with payroll deductions, and being able to notify payroll how to take the deduction change, when to take the deduction change, and so on. So it's nice to have those features in your plan when they're a long period, long offering period. But on the other hand, from the administrator's standpoint, it can be pretty crazy to maintain.
Absolutely. So definitely limiting any of those types of changes is going to help make your life much simpler. And of course, if you have a shorter purchase period, definitely 3 months or less, you really don't need to allow changes like that because it is a relatively short period of time. I think with 6-month plans, sometimes employees might be allowed one decrease. But again, it's not that long of a period of time, and employees are usually able to withdraw anyways if they really have something urgent come up and need to pull the cash out of the plan.
Yeah.
So we're going to talk about sales and transfer restrictions on the next slide, but there is one last little chart here showing the impact on participation rates of having a sales restriction, which is where upon purchase there's a period of time that employees are not able to sell the shares from that purchase. And obviously a restriction like that is going to have a little bit of a negative impact on participation rates. But Emily is going to dive into this a little bit more on the next slide.
Great. Thanks, Liz. So, Liz gave you a sneak peek that sales restrictions do impact participation in the plans, and that's why, to be honest, I'm not a huge fan of sale restrictions. A sale restriction requires that the employee hold the shares. They are prohibited from selling them for some period of time after they purchase them. And as you can see, that the bulk of plans do not include a sale restriction. 78% of the plans that we support don't include a sale restriction. We have 11% of plans that have a 3 or a 6 month restriction, and 11% of plans that have a 1 year or greater restriction. And most of those, to be honest, are 1 year restrictions. When I think about the population that you're targeting from an employee stock purchase plan, you're really looking at a broad base of employees, and those employees may not be equipped to weather the stock price volatility as well as your executives are. So I think that, holding requirements are very common at the executive level, but it doesn't necessarily translate as well to a broad-based population, and it can have a negative restriction or impact on your participation. I think companies put in sale restrictions because there is somewhat of a misperception that employees use ESPP as like an ATM machine, right? That they buy the shares and they immediately flip the shares. In a separate analysis that we did of our ESPP participants, we actually found that that was really, truly the smallest minority of participants, with only 3% of ESPP participants selling their shares within the first 10 days. So it's a really very small population of employees that are selling the shares right away. Absent a sale restriction, there will always be a handful of employees who do it. But in general, employees are not flipping the shares immediately. The data shows that to us. Now, the other side of the chart here is a transfer restriction. And while I'm not a fan of sale restrictions, I am a huge fan of transfer restrictions.
Yay.
Because I think, yes, this is a gift to the plan sponsor. A transfer restriction does not impact the employee's ability to sell the shares, but it impacts their ability to transfer the shares out of their captive broker account. So they can sell the shares whenever they want, but they have to sell them from the captive broker's account. The reason that this is such a benefit for plan sponsors is this allows you to maximize your corporate tax deduction by capturing 100% of your disqualifying dispositions, and it minimizes your administrative headache by getting you out of the survey business. If you allow employees to transfer those shares out of the captive broker account, you lose your ability to track the shares. And that means that you have to reach out to those employees on a regular basis and ask them if they've sold the shares. So I love transfer restrictions for that reason. Now, as much as I love this, you do, yeah. But I look at this, Julie, and I'm like, I have obviously not been persuasive enough with my love of transfer restrictions, because half of our clients don't have any transfer restrictions associated with their plan.
Yeah, and we find so many times that the company says, well, we don't want to restrict our employees. Well, you're not restricting them. They can still sell the shares. It's just that you're requesting or kind of restricting and requiring them to keep those shares at their captive broker so that you have control over those dispositions. And it's to the benefit of the employee as well, so that they get the reporting of their qualified dispositions just as well as they get their disqualifying dispositions reported correctly.
Julie, it sounds like you could be my co-collaborator on, trying to convert the world on transfer restrictions.
Sometimes, I think what happens is sometimes people overthink this, and they want to make this as beneficial to employees as possible and make them all so very happy, which is great. I'm all for that, but it doesn't help the company at all, right? It's more burden on the company. It costs them more to maintain the program.
Right. And so maybe there's a middle-of-the-road approach here. While I am a big fan of permanent transfer restrictions because, of course, the tracking and the reporting is required until the shares are sold, regardless of whether it's a disqualified or a qualified disposition. So I'm a big fan of permanent transfer restrictions, but in reality, the bulk of the transfer restrictions that we are supporting today appear to be aligned with the disqualifying disposition period. And for that purpose, at a minimum, think about a transfer restriction until your shares have passed out of that disqualifying period, because that does allow you to capture all of your corporate tax deduction. Now, as a plan sponsor, if you offer a qualified plan, you still have an obligation to track those shares. It gets harder and harder to do that the longer it gets out. And there's also a fewer number of shares the farther you go from purchase date. So at a minimum, I would say that plan sponsors should consider transfer restrictions through the disqualifying disposition period. If you can, I would consider it for a permanent transfer restriction. And the final chart here shows that it's definitely more common for qualified plans to have transfer restrictions than non-qualified plans, and that is because of those tracking requirements. All right, Julie, I'm going to pass it over to you now.
All right. Actually,
no,
I'm not. This is going to Liz.
Sorry. Yes. All right, so here we look at combining the length of the purchase period, the discount level, and the purchase price type. And obviously there are many possibilities here, and so we've grouped some of these into broader categories to make it sort of easier to digest what we're seeing, across the market here. The single most common design, which shouldn't be a surprise to anybody, is a 6-month purchase period, a 15% discount, and a look back. And when we add in to that plans that don't have a look back, we see 43% of plans have a 6-month purchase and a 15% discount. The next most common seems to just be 3-month plans without a look back. I think those are pretty evenly distributed across the different discount levels, 5, 10, and 15%. But this is what we see from a high level overall for the most common types of plan design.
Great. And that all begged a question for me. And that question was, when do the purchases actually occur? And I know, Emily and Liz, that really wasn't something that you looked at in your survey, but we did look at the NASPP survey from 2013 and looked at some of the time frame from which the actual purchase date occurred, because from the administrator's perspective, that can be problematic in itself, especially when you're talking about quarter-end purchases, end-of-year purchases, end-of-fiscal year purchases. We always see December 31st as a big purchase date. Well, the problem with December 31st is it's sometimes it falls on the holiday, therefore a non-trading day. Does it fall, what does your plan say about when you make that purchase? What's the price to be used? Is it the December 30th price, or is it the January 1st price? And it becomes a real challenge from the administrator's point of view. It also, when you have purchase dates at the end of a period and you're trying to do your month end or your quarter end or your year end, and you're doing your purchases at the same time, it seems like you've just created more problems for yourself than you really need to. And so we try to encourage people when they're coming up with a new plan is to try to push some of those purchase dates into some non-critical dates, if you will. And it was funny to see this survey result where 29% of the people avoided all of those ugly dates. So I'm hoping that we see more move in that direction over time, that people start avoiding those, end of something dates, which just adds to the level of complexity from the administrator's point of view.
And Julie, now you've got a bunch of people out there wringing their hands saying, well, my purchase date is December 31st. Wow, how did we end up with such a miserable pick on this? The silver lining here is that you're not stuck with that forever. So your plan may give you the flexibility to change those dates. At a maximum, you might have to get board or committee approval. It definitely doesn't have to go back to shareholders. And so this is something that you can plan to change. And the way that you do that would be by having one period either truncated or a little bit longer. So if you have a 6-month offering, maybe you have a 5-month offering instead for one period to get you off of that cycle. So it's something you can fix.
Absolutely, absolutely.
That's definitely a trend I see for companies putting in plans. as soon as we mention this to them, they love the idea, and they, go for the middle of the month.
Right.
Yep.
Right.
Yep.
But we actually, you also have to watch the middle of the month from a payroll's perspective, too. So, the 15th of the month can be a pay date for a lot of companies. So they don't think about that either. And then all of a sudden they're going, okay, now I've got this last payroll, but I don't have all the details yet. So I can't make the purchase because I don't know the number. So they've got to pick the right balance there.
All right, so let's take a quick look at plan design by industry. And I have 2 slides on this. I'm going to cover this pretty quickly. When we did this analysis, Liz and I really wanted to get to some of the questions that we were getting from clients about, does plan design vary by industry? And the answer is yes, it absolutely does. And I don't think it should be a surprise to anybody on the phone that technology and medical and biotech tend to have the most aggressive plan design. We also see in this sample that energy they're almost right there up there with technology with respect to the aggressive end of it, but the sample of energy companies is relatively small here. By and large, we expect to see the largest or the most aggressive plan design in technology and life sciences, industries that use equity compensation more aggressive. On the next slide, we broke it out a little bit more to cover the specific plan design elements by industry. So if you're interested, you could take a look at this to see purchase price type, sale restrictions, and discounts by industry, and there definitely are some variations on that. So that wraps up the design element, and now we're going to move towards plan participation. So I'm going to turn it over to Liz to kick us off on that.
Yeah, so we've set the stage with prevalence of design features both across the general marketplace and by industry. But when Emily and I started this study, the main question that we wanted to answer is how much plan design decisions impact participation levels. When we look at participation from a high level, the total participation rate across all plans is 25%. It breaks down to about 28% for U.S., 17.5% for international participants. But you'll see as we dig into the details, there's variations across design features, as well as we can also see which design decisions have the biggest impact on plan participation. So first, just looking at some individual design features before we combine them all and see what the impact is, nothing here I think is too surprising. We see that qualified plans do experience higher levels of participation than non-qualified plans. We see that the 6-month plans have the highest levels of participations of all of the lengths of purchase periods at 31%. The one thing that's a little interesting is that when you go to a longer purchase for, say, a 1-year purchase period, participation rates do start to drop off. Maybe employees are a little bit nervous to tie up money for a year. Maybe they think it's riskier to wait a little bit longer to have access to those shares. And then, of course, as expected, having a highest level of discount for a qualified plan of 15% and also having a look back are things that are going to give you higher participation rates. One thing to note, looking at the level of discount is we do see non-qualified plans that have a match have decent participation rates as well. And that obviously makes sense because we know that these plans can be just as generous or even more so than qualified plans because there's more flexibility on the design. So what we see overall from this chart, I think, is that our discount level and the look back are going to be the biggest drivers of participation. And that makes a lot of sense because those are the things that, employees recognize as being the most beneficial to them.
All right, so let's take a look at some more cuts by participation. And here we're looking at the participation by price type and discount on the chart on the left. And I think it should be no surprise to anybody that plans that offer a 15% discount with a look back have the highest participation overall. And then What I think is a little bit more surprising, though, is that when you look at the impact, discount definitely has the power to drive participation the most. So while adding the look back is going to bump up participation, discount is the largest single driver of participation. So where a company is, considering, say, a 15% discount without a look back compared to a 10% discount with a look back, I would expect that participation would be greater in the 15% plan without the look back, because everybody understands how a discount works, and it seems to be very effective at driving participation in these plans. Now, on the non-qualified front, we see those match programs are driving participation to a greater extent than the discount programs. And again, the reason that companies pick match programs often is because they can do a share match program, and in many cases that matching provision will be as generous or more generous than a 15% discount. So we do see relatively high U.S. participation rates in those non-qualified plans that offer a match.
All right, and then looking across kind of the overall plan design picture, obviously we see these trends continuing here. So the highest levels of participation occur with a 6-month plan that has a 15% discount and a look back. And that's about a 39% participation rate overall. And then similarly, when we look at annual contributions based on plan design, we see the highest levels of contributions, the amounts that employees are contributing each year on average, that's occurring for plans that have a 15% discount and a look back. We see that, the 3-month plans was a little bit higher than the 6-month, but it's not surprising that those are the 2 highest levels. And I think our thought here was that maybe with a slightly shorter period, employees were willing to tie up more money because they could then access it quicker. Even if they didn't necessarily sell it right away, mentally they knew that they could get to it if they needed to.
Yeah, I think it's the mental thing there that, I need to get to my money, I can get to it.
Yeah, inertia drives people to leave it there, though.
Yeah, that's true.
All right, so now we have a few slides on participation by industry. And before I jump into this, I did just want to call out that on all of these participation slides, we have broken out total participation compared to U.S. and non-U.S. participation. And across the board, you do see non-U.S. participation lagging U.S. participation. I think there are a number of reasons for that. First and foremost is likely that outside the U.S., these are not tax-qualified plans by and large, which means that the employees have a taxable event at the time of purchase. Your non-U.S. participants are also subject to exchange risk that your U.S. participants don't bear. And when you think about these plans, these are broad-based voluntary plans. So you are offering this to essentially all of your employees, and when you do that on a non-U.S. basis, you may be getting into a population of employees who are perhaps not fluent in English and not as financially sophisticated or familiar with the concept of securities ownership. And I think all of those things do drive non-U.S. participation lower. That it impacts those participants' willingness to get into the plan. But when you looked at general participation across the industries, it should not surprise us to see that participation tracks very closely to design. So where industries have aggressive plan design, we see that they have the highest level of participation in their plans. And on the next slide, we broke it down. It becomes a little bit of an eye chart here. We looked at total participation rate by industry. You probably need your magnifying glass out to see this. And we broke it out by different plan design combinations. So again, the plan designs that offer the most value are driving the highest level of participation in those plans. And then on this final chart on participation by industry, we broke it out for different components of design, discount, purchase price, and sales restriction, to see how they varied across different measures by industry. So, there's a lot of data on these slides that you have access to them all, so I'll let you look at the slides on your own and perhaps look at the industries that are most important to you. But now I want to turn it over to Liz to talk about the trends we saw from 2014 to 16.
Yeah, so as Emily has mentioned, this is the second time that we have done this study, and so you are all seeing for the first time the latest data that we have here from the 2016 study. And just from a high level, we didn't see any significant changes from 2014 to 2016. We did compare prevalence and changes in participation rates across all of these different design features, and of course, for the purposes of controlling the number of slides and charts that you have to stare at, we just selected a few to share. Overall, the trends that we saw were subtle, but the changes were positive. Things were moving in a direction of being, more beneficial to participants. And you can see that here with a few of these that we've shown. We've seen a slight increase in qualified plans compared to non-qualified plans. We see a slight increase in plans that have look-backs compared to plans, that are based on an ending price. We see a little bit of an increase in plans offering the max level of discount, which is 15%. We also see a very slight increase in companies that don't have a sales restriction. So these are all things that employees are going to like and that are going to hopefully, drive participation. So then similarly, when we take a look at how participation rates changed from 2014 to 2016, we do see a little bit of an increase overall from 21 to 25%. And again, looking at overall plan designs, we're seeing more of these 6-month plans with a 15% discount and a look back. So obviously we would expect those two trends to go hand in hand because design and participation are intertwined.
And, Liz, that's a good point that the trends were subtle. They were positive, but they were subtly positive. We didn't see a huge change in plan design. The changes we saw were positive, but the uptick in participation outpaces the uptick in plan design. So, I think it is interesting to see that even though we only had very marginal increase in design, we saw a much bigger uptick in participation, and that perhaps could be suggesting that companies are doing a better job of educating their employees about these plans, which is driving participation as well.
And we're actually seeing a real big uptick in our clients looking at implementing new or improved ESPPs. So, and maybe they've realized that this is the right thing to do now, and they're pushing a better plan across.
Absolutely. And for companies that do already have these plans, they don't necessarily need to reinvent the wheel. They just need to make the most of the plan that they do have and get the word out.
Right.
And so continuing with the subtle improvements in plans, we saw an increase in non-qualified plans as well in terms of, the percentage of companies that didn't have a match or a discount or on the decline. Companies that have a match are very much on the rise, a slight decrease there in non-qualified plans that offered a discount, but I think that's because they were switching to a match instead. So again, nothing real dramatic here. Obviously the non-qualified sample size is smaller than the qualified sample size, but all positive changes that are helping participation rates rise as companies implement or improve their plans. So I think that brings us to the end of our material. I know there's a couple more slides in the appendix that you'll be able to see after the fact, but I think that we wanted to take the last few minutes here and open it up to questions.
Yeah, and we did have a couple of questions that came in throughout the presentation. The first was someone was asking, we have a 2-year plan, any other companies with 2-year plans? And I think we sort of addressed that early on, that those are more like the Cadillac plans, and Emily, I think you said those don't, they're tending to go away. We do see them though on our side when we have a lot of technology type companies that are still trying to implement those. So they're not gone, but we are hoping that they become less and less, if you will. The next question was, we use the 25K to determine the number of shares as a limit per offering period, and many reach the limit as a result of that. And I think we addressed that as well. We would like to see that the maximum number of shares actually be defined within the plan itself and not rely on that 25K limit, but I still do see companies rely on that. And the last, go ahead.
Oh, I was just going to say, if many people are reaching the limit, I guess it also kind of depends on whether that's a problem or not for your company. Like, maybe, do you want a lot of employees to be contributing the maximum allowable amount under the IRS limit, or is it causing you to chew through shares quickly? So maybe you do need to consider a lower share limit, to help control that. So, it depends on what your goal is for the plan.
Right, that's a good point. You could, in fact, have situations with that where I guess you could have somebody making a purchase, if you had a number of 6-month purchases, 4 6-month purchases in your offering, and you had somebody hitting that limit all the time in the second purchase. Now you've got an issue where you've got to probably refund them some money from payroll at the same time. So maybe your design needs to be thought through a little bit more on that, maybe refined a little bit.
And, I'll touch on here as well. I have actually seen a number of companies with really successful dollar limits. Say a dollar limit of employees can contribute $5,000 per quarter or $8,000 per year, and that is a little bit easier for you to track from a payroll perspective and max them out when they've hit that dollar limit, rather than using a share limit, because the share price can change. So using a dollar limit can be an easier thing to track against payroll and prohibit employees from over-contributing to the plan. The other thing that I really like about a dollar limit is that it can be a really helpful way to manage your share usage and to minimize your expense under the plan. So where companies are concerned about the compensation expense, putting in, say, an $8,000 annual limit on contributions, that would allow lower paid employees making up to, say, $80,000 a year, to contribute to the max if you had a 10% max on it. But it would restrict higher paid employees to that $8,000 a year as well. What that's going to do is it's going to reduce the number of shares that you purchase under the plan and subsequently reduce the compensation expense that you recognize for the plan. And presumably, your higher paid employees may have access to equity compensation through their long-term incentive plans that your lower paid employees don't have. So that can be a way to sort of, prioritize the employees who don't have access to other forms of equity compensation and let them get the maximum benefit out of the ESPP while restricting some of those higher paid employees.
Yeah. All right, another question had to do with plans that have quick sale programs or same-day sale type features. Do many plans have those? And did you see any of that in your survey?
So I can address that. So according to the ESPP Stock Plan Design Survey from 2014, only 6% of companies offer a quick sale or auto sale feature with their ESPP. It hasn't been something that I've heard a tremendous amount of interest in, because I do think that, while I'm not a big fan of sale restrictions on the plan, I also can understand why companies don't want to automate the immediate sale of these shares. So it definitely is a relatively uncommon feature for companies to have associated with their plans, just 6%.
Yeah. We have a few minutes left, and I know Shauna's going to want to wrap us up soon. So let me just try to pick a couple of other questions that came in. I don't know that we're going to get to all of them. Is it common for plans to allow a total withdrawal of funds prior to the purchase date? And I can speak from the plans I've seen. I would say yes, because there are those hardship cases. So we do see that most of the plans that would come across our desks do, in fact, allow for withdrawals. Did you see that all plans had those, Emily, or just?
Yeah, and we addressed that on slide 7. So 67% of the plans in our data set do allow a full withdrawal of funds, with 33% not permitting it. Now remember again that we do support plans that are, 2-week plans or 1-month plans. The 2-week plans aren't that common. But with a 1-month plan, it may not be necessary to permit a withdrawal of funds. So the 67% represents the majority of plans that are 3 or 6 months long do allow those funds to be withdrawn.
Yeah. And then there was a question about the percentage of companies that offered the Cadillac plans, and I don't have that available to me. I don't know if either of you have any of that information. But
I don't have it. I'd be happy to look it up on the NASPP survey following the call.
Yep, we can do that. All right. There was just some responses to the answers that we gave, but I think we're good. So, oh my goodness. Yeah, we're going to have to get back to some of these because they're coming in fast and furious, and we're going to run out of time. So we will definitely get back to the questions that have come in and get you an answer, and I'll pass it back to Shauna.
Thanks, Julie. I'd like to thank you and Emily and Liz who joined us today, and thank all of you for attending today's educational webcast. Please do look for an email in the next few days with links to the recording and materials. If you did ask a question here at the tail end, we'll go ahead and get back to you via email as soon as possible. Thanks so much and have a great day. Bye-bye.